Let's turn back to the major averages. Joining me now is Michelle Schneider, partner and director of trading research and education for MarketGauge.com. Michelle, it's great to see you on Closing Bell. We did have a mixed market today. The Russell 2000 was able to eke out a gain of 1%, but mostly lower and down for the week. What is driving the recent volatility?
Well, there's quite a few factors. The obvious ones would be Omicron, and it looked like when the news of it came out that it was going to be relatively milquetoast, but it turns out now it's increasing in numbers, even inflecting the NFL, which is postponing 3 games, which is sort of a historic thing. And so fears have come back, as I heard you say in the beginning of the show, during a very heavy travel season. And then, of course, Jerome Powell this week didn't really give a lot of comfort to the market as well. The hawkish tone about raising rates and speeding up the pace of taper, I'm not so necessarily sure that's what spooked the market. I think what spooked the market is that his tone, even though he didn't use the word transitory, was still relatively transitory in that he's talking about, okay, maybe inflation's going to last about a year. And that was based on some numbers that he said that he expects to go up within a year, but then come way down in 2023. So that's really going to be the X factor, is if he's wrong, what happens? If he goes any more aggressive, we can see what can happen to the market and the whole economy, which now has to go through another slow period with the virus. And if he's going to be too dovish, then we can see what can potentially happen in inflation, considering now after each slowdown we get from the virus, we come back with a surge of people wanting to get back out, which is also inflationary. So it's a tough spot for the market, and that's why we're seeing a lot of jockeying here and liquidation.
Yeah, I think since, the Black Friday, the day after Thanksgiving, the worst day for the stock market this year, we've had an up week, a down week, an up week, and now a down week again. Michelle, as investors do try to digest these mixed signals, and even the Fed has said that it's challenging to really kind of predict the path forward with Omicron and the coronavirus still being a risk to the economic outlook. I think what is interesting here is bond yields continuing to tick a bit lower. That 10-year Treasury yield, which has been dictating the path for technology names this past year or so, did move down to 1.41% today, yet the NASDAQ still under pressure. Have you seen any decoupling from that 10-year Treasury yield and the NASDAQ? It seems, again, after moving in lockstep for months, this past week or so, the two have not really been so much in sync.
Yes, because originally, well, I shouldn't say originally, but classically what we've seen is low yields, great for the growth stocks, obviously low interest in terms of costs and things like that. But right now, what we're seeing is a philosophy change of low yields in the face of England raising rates and us talking about raising rates next year, more of a defensive play. And so I think the big cap growth stocks, which had a lot of corporate buybacks also, which led to its huge gains, and technology in general, just cyclically even, are starting to show weakness, while some of the stocks that have been really hammered actually showed some strength today. And a lot of it, of course, having to do with disruptive tech and stay at home and in preparation of what could happen in the next couple of weeks. So, yeah, these relationships change quickly, and people have to be quite nimble.
Michelle, I have to get your take on Peloton. I know you do follow some stocks, including stay-at-home stocks, and I couldn't help but think, after what's been a rough week for Peloton, and certainly a rough year. I mean, that stock down more than 70% from its high just about a year ago. Shares ended up higher today. They ended up higher on the week, and I can't help but think that rising COVID cases would be a benefit to a company like Peloton.
Well, in terms of branding, it kind of reminds me a little bit of what's happening with Rivian, in that when Peloton first came out, it was very sexy, and then and of course then it got the whole stay-at-home crowd, and then the reality set in that really basically it was like plopping a laptop on top of a stationary bicycle, and it really fell out of favor. Just like Rivian now is, even though sexy looking, the reality is hitting that there aren't that many cars. So what happened with the Sex and the City is obviously unfortunate for the company, unfortunate for Chris Noth. But in terms of the actual bicycle itself, I think I was looking at getting a Peloton, and so if you're going to put on the consumer instinct, I think if the prices come down to a level of relative value, it could base out as it's trying to do. In terms of it having like an incredible future like when it first came on the scene, that I'd be a little bit more suspect, especially if consumers are going to continue to feel the pinch of rising prices just all around.
Right. And that's the other factor, right, is that as more things are open and inflation has only risen to the highest level, at the highest pace that is in nearly 4 decades for consumer prices, right, are you going to spend money on a very expensive bike or treadmill when you might have already probably purchased it earlier in the pandemic when the lockdown was more in force? But I just have to ask a follow-up here, because down 70% from its high just a year ago, I mean, a 75% pullback alone, is that a buying opportunity that you might look at, Michelle, because of the steep fall?
Well, yes, I like these sort of basing actions. And by the way, that's not the only stock that has fallen so much. Just look at a lot of the holdings in the ARK fund. So many of them have gotten killed, and some of the companies could be interesting now. And then some other stocks like Roku, which got beat up. So Peloton is one of the group. I think it would really come down to, first of all, let's see what happens next week. Everything rallied today. There was a lot of short covering and just sort of transfer of money. Would I go to Peloton as my first pick? Probably not. I would probably be looking more at companies like Peloton that came back a lot today, and Fastly that came back, and Teladoc. These are the ARK holdings. These are the things that might have some real future because they have pricing power. They're not going to pass higher costs on to consumers. So Peloton would be worth watching. When you get a good low, you have a good technical signal to risk against. But again, not my first place that I would put my money, at least not right now.
Talk to me about the market breadth, Michelle, what you're seeing, the signals that you're able to glean from that, and what we might expect heading into year end because of how stocks are moving.
Well, I think one of the most things that have my absolute fascination here are the small caps. Because if you take a look at 2021 at the Russell 2000 IWM, it literally has been in a trading range for a year. I don't think I've actually really seen that too often. And generally, when you have that kind of compression and consolidation, a big move is coming. Can I tell you definitively whether it's up or down? No, not really. But all I can tell you is very clear on a chart that if it breaks down under, let's say, 207, if we're looking at IWM, that is not a pretty picture. And we can already see retail breaking down from some consolidation. And that, of course, is 70% of the GDP. And, of course, on the flip side, if it can get back through 233, defying logic or anybody's particular bearish tones right now, that would actually be a really good sign and hopeful for the economy, because what's in the small caps is a lot of industrial and a lot of manufacturing. So I'm looking at that very, very carefully right here. I'm also looking at junk bonds, believe it or not, because junk bonds really are the greatest way to measure risk on or appetite of investors who want to buy companies that have bad balance sheets but high yield debt. And so, you know, those two things together right now, the IWM and that, they're holding here at good range lows. They have to continue to do so. Otherwise, I think things can get really ugly, at least for the first month of 2023.
Michelle, one more question. 2022. I know.
I'm ahead of myself.
No, absolutely not. But look, as we head into 2022, I think a lot of people are probably revisiting their portfolios. Any changes that you would recommend that people make to their investing portfolios as we head into the new year?
Well, I definitely would be protective over my big cap growth stocks. You know, all the people that love Apple and Microsoft and Advanced Micro Devices and all the big tech companies, you know, we have to wonder whether or not those can continue to go up, particularly if we have any kind of downside. So locking in is probably a really good idea. I love to talk about commodities because most of the people's portfolios are very underweighted in commodities. It may be a good opportunity to be looking especially at some food commodities. And then also on top of that, even though precious metals have been really underperforming, they've also consolidated here. And if anything happens that would be more inflationary and really sends a signal that the Fed is losing control, even though a lot of people think that's already happened, you could actually see a surprise move in some of those precious metals. And then, of course, defensive stocks. Utilities have gone up to new all-time highs, consumer staples, new all-time highs. So you want to look at companies that are, A, selling things people absolutely need, and again, that pricing power where necessarily doesn't have to pass on higher costs to a consumer, like a Palantir, for example.
All right, Michelle Schneider, partner and director of trading research and education for MarketGauge.com. Michelle, thank you so much.